All right, here we go. Let's see, mid-market update. I'm not going to go through all of these things, just like skim them. The main thing to know about really it's kind of whenever I'm talking is this little hidden sentence right here, which is past performance is not indicative of future results, right? So if you have any experience in investing, you'll see that statement all the time. So what it means is we're going to look at a bunch of charts that show us what's happened in the past, and then we're collecting all of this information and we're putting it together and we're trying to make predictions or forecasts about what happens in the future. But the whole point of the future is that we don't know for sure what's going to happen, right? That's what makes this so exciting. But when we're talking about investing in finance, we always have to remember that it's forward-looking, right? We are looking to the future. If you think about like accounting as being the place where you take all of your transactions and you put them into categories, that's backward-looking, right? And like that information is valuable, but in investing in finance, we're always trying to figure out what's about to happen next at some point in time, maybe in the short term. But like when I think about it, it's like, what do we expect to happen over the long term? So there's all sorts of stuff, not investment advice, no guarantee of results. You guys know all this. There's going to be some hypothetical or illustrative examples. There's risks, limitations. Like if you put your money at risk, there's a chance you'll lose money, either in the short term, temporarily, or forever, right? So we'll talk a little bit about that and regulatory compliance. Financial services is a very regulated industry. If someone is registered as an investment advisor, we have to follow a lot of regulations, so that's there. Here's a little bit about me. I'm not going to spend too much time on it, except to point out that another member of AWIG and I started this podcast called Women on the Verge of a Financial Breakthrough, where we try, is my friend Caitlin. She's a journalist. She's the most interesting woman alive, and she asks some really good questions. And some of the questions are just literally, how do I start? What's the first step? Or why would someone invest in gold? Or what's Bitcoin? Or what is a stock, right? So we're on season 4, but we have 3 seasons already up where we try to cover the questions that we have heard in the Awesome Women's Investing Group for over 10 years now. And we try to kind of collect it into Women on the Verge of a Financial Breakthrough. So I think that's a little pat on the back. I think it's a good resource. So whenever I talk about stocks, like those of you who have heard me do some version of this before, you'll know that I always like to start with this idea that this is stocks for the long run. There are lots of courses or trainings or different things you can do about speculating in stocks, right? Like trying to get rich quick, trying to predict with accuracy moves in the short term, and this is not it, right? So this is something different. So this is my very favorite Warren Buffett quote, which is someone is sitting in the shade today because someone planted a tree a long time ago. So that means going back to getting started, you have to go through this work of digging a hole, right? Putting the seed in, covering it up, and then it has to rain, and then you have to give it time. All of those things are components, right? It's not, it takes work to do it. And it also takes a ton of time. So just kind of keeping that in mind, I always like to think about the stories that people tell about their family members who planted these seeds a long time ago and how people in the present are benefiting from that. And then we can think about it for ourselves, how might our future selves benefit from the decisions that we make today? So it's all kind of, again, tying that today to the future. All right, bulls versus bears. So just for terminology, a bull market is when prices are going up, right? So you can think about the horns of a bull, tossing someone into the air. And bears, you can think of the paw swipe coming down, slashing across your face, causing a lot of damage. Bear markets is when prices are going down. So that's what we're talking about. That's market lingo that just to keep in mind. Those two, bulls and bears, are always tug of warring with each other. When we first talked about this in AWIG in January, we were all very anxious and stressed out about what a change in administration looks like, right? Now we're 6 months in. Now we kind of have some more information than we did from back then, right? So the tug of war continues, but the bulls have staged to come back. So we'll talk about that a little bit. All right, so this is just showing price volatility. I know the lines are a little, hopefully you guys can all see. Feel free to scoochie up or ask me to point out what we're looking at. This is a price chart of different parts of the stock market from election day through Friday, right? So we can kind of see, we have the pink line is the NASDAQ. So think tech heavy stocks, right? So NVIDIA, Apple, Meta, big tech companies. The S&P 500 is usually what we use as the broadest example of the stock market. It's 500 large US companies. You've heard of most of them, right? But there's 500 of them. And then the Russell 2000 are smaller publicly traded companies. So think like small stocks. And so we can see that like right off the bat, after the election, the stock market kind of trended up, or all these different parts of the stock market trended up. Then kind of February, March, things started a decline. Then we had Liberation Day, April 2nd, which shocked everybody in the markets. And we had this precipitous decline through April 9th, which then tariffs were off for 90 days, market rebounded. And since then, market participants are trying to figure out and get comfortable with like what is happening. And I will say, like, nobody knows exactly, but you kind of go like this trend of like, oh my gosh, like I knew way less than I thought I did a little bit ago, to like, okay, well, we know a little bit more. Kind of think about like changes in trends versus having all of the answers. A lot of that change in trend explains stock market movements, if that makes sense. Things getting less worse, right? Things getting worse, things getting less worse, right? So it's not necessarily about solving all of the problems and having all the answers. It's about things being a little bit less worse than they were before, or a little bit more worse than they were before, if that makes sense. So now we're kind of all sort of back to where we started. The markets are actually up since, most of the markets are up since election day. So since November, the NASDAQ is up 12% since then. The S&P 500 is up a little over 8% since then. And our poor little smaller companies, which you can imagine like small companies really being impacted by tariffs. They don't have the resources that the larger companies have, and they really have yet to make any like actual headway since election. Any questions on this? I mean, we can just eyeball this and be like, there's a lot of volatility there. That's what yeah, that's exactly what it looks like. V-shaped recovery. It happens, goes down really fast, comes up really fast, right? So here we're looking at a long-term earnings trend. So I'm just going to stop really quickly about this word earnings. I kind of just mentioned it on the previous slide. Earnings are the fundamental underpinning of the stock market. So if you think about a company making money, I go to the Apple store and I need a new phone. So I give them $1,000 and they give me a phone. They take that $1,000 and they put it in a bucket called revenue or sales, right? Or the top line. Annoying because those are all different phrases for the same thing, right? Like the top line. Then Apple has to pay the cost of making the phone, the cost of materials, cost of goods sold. They have to pay the people that work at Apple. They have to pay any interest on any debt that they've borrowed. They have to pay taxes. Once after all of those other obligations get paid, there's something left over, hopefully, right? Not always, but hopefully there's something left over, and that's called earnings, or profits, net earnings, net profits, the bottom line, right? Because it's at the bottom of the income statement. But earnings are what the owners of a company care about. Everybody else has gotten paid. What's left for me, right? So we're in the beginning of earnings season. This is when these big companies, it started last week with very large banks. I think Netflix reported late or earlier this week, maybe yesterday. All these companies are saying, okay, this is how much money we made last quarter, and this is how much money we think we'll make next quarter. So we're getting a picture of what happened and what people think is going to happen in the future. So it is knowable, right? Like earnings are reported every quarter, and people keep track. They take, of these 500 companies in the S&P 500, someone adds up the earnings that all of those 500 companies create, and they put it on this little chart, which is the gold line, and we can see how earnings fluctuate over long periods of time. We kind of expect, and we don't kind of expect, we absolutely expect that if the US economy is growing, the companies that make up that economy are also growing. And in the aggregate, that earnings would be growing. So that's why the chart is upward sloping. Not perfect, right? Because we also have business cycles. We also have COVID. We have crises. We have financial crisis. We have bubbles. We have all of these things that also are happening. So it's not a perfect line. But the trend is that, okay, in the US, this company was, or this country was specifically built as like loving capitalism and taking risk and keeping the rewards. And that's what the laws do here. And it's still the largest economy in the world. It's still like the most robust capital markets in the world. And so if we think about like, well, what do we expect in the future? Unless something really, really dramatically changes, we would expect the trend to continue going forward. But sometimes people think, or they'll say like, the stock market is just gambling, right? Or it's just a casino. And so there's lots of studies that show like in the very short term, that's true, right? There's a really famous book called The Random Walk Down Wall Street that shows like from day to day, you can't really predict, is the market going to be up or down on Monday, right? Like 54% of the time in one day, the market's up, but that's basically a coin toss. But as we stretch out that period of time, the odds are greater that you're going to be able to make some money, right? So we need time to think about this long-term trend and not get so caught up in the short term if we can at all avoid it. Does that make sense about like this fundamental underpinning of the market? Like stock prices move because of people's expectations about earnings. Like it's pretty fundamental. And so we can look at like my very favorite chart, which is now like bringing this like very, very close together. The blue line is S&P 500 reported earnings per share. So the blue line is earnings. Now it's on a different scale. It's on a log scale. And now it's charted versus the S&P 500 index. So if you listen to financial news, they say S&P reached 63.12 yesterday. They're telling you the price of the S&P 500 index. So we can see here, you can just eyeball it and be like, hey, that's a pretty close relationship. Typically, if earnings go up or are expected to go up, the price of stocks in the aggregate will go up and vice versa. So again, there's this, why do stock prices move the way they do? It's because of earnings and profits and our expectations about that going forward. We had this like super massive fall off in earnings, which is very obvious, right? This is the financial crisis. So you remember like when the financial crisis hit, 2008, 2009, banks reported negative earnings. And that had maybe never happened before, right? All of a sudden banks are just losing money because no one's paying their mortgage anymore. And so we had this super dramatic decline in earnings. But we can see back here, if you think back to COVID, right? Like how are companies going to make money if we're all just sitting in our house? Like it took a little bit to figure that out, right? So we had a decline in earnings. So that just happens either as part of a normal business cycle or because of, you know, something idiosyncratic. It doesn't really matter. Just the idea that when earnings fall, you expect the price of stocks to fall and vice versa. Any questions on this? Yeah. I mean, first of all, I mean, that's an excellent point. First of all, it was a week that tariffs were announced on Wednesday the 2nd, and tariffs were called off on Wednesday the 9th, right? The original like tariff announcement was so far out of the realm of possibility that anyone expected. They were so bonkers. Everyone was caught off guard, which is why you see the decline. Yeah, yeah. It took, I mean, so now, like, but it didn't take, it was 1 week, right? Of like, how do we possibly adjust earnings to reflect these insanely high numbers? Yeah. 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 Join the club, which is everybody. It's really hard, right? We had, I mean, really, I had a handful of people who sent money and specifically like this, like, I'm going for it, like during that week. Most people were like, what is happening? Right? Because it's only a week to digest what is happening. It's not long enough, right? Yeah, yeah, it is. And a week is a very short period of time for the market to fall 20%. Like up until that point, the most dramatic decline had been COVID, when the market fell by 34% in 3 weeks. And this was the market falling almost 20% in 1 week, right? So all these things are very or sudden, right? Yeah. That same day, it was Wednesday, is that same day. And then Besant had this crazy meeting. Yeah, certainly we don't have the president of the United States front running stocks or telling people to front run stocks, certainly, right? But here we are. So, yeah. No.
We would never.
Oh, yeah. Yeah. That's awesome. Well done. That's amazing. Yeah. 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 I mean, we have like, if you do rebalancing, this is also hard because it's happening right around tax time. So if we just go back 3 months, people were paying attention to this, but they were also trying to get their taxes done, right? So we have a lot happening in one time. We have, or like for my clients, I do monthly rebalancing on the 15th, right? So this is, the bottom is the 9th. The 15th is over here, right? I mean, what can you do, right? Like, there's only like some people have a trigger. If the market falls by 20%, I'm going to put money in. What if the market falls by 18.9% and doesn't trigger your limit, right? So this is like where it is all like nearly impossible. We do the best we can to take advantage of things if that's what we're into. Some people do the best they can to just ignore it. Like, oh my gosh, like call me when it's over, like whenever that is, right? So every investor has to figure that out for themselves, right? Am I looking and paying attention enough where some decisions are being made, or like, oh my God, Sarah, do not call me or send me an email. I don't want to know. Which is also great because you didn't sell. Like think of like all the people that sold here. That's why the price is going down, right? So we have to figure out for ourselves like what we're doing. Are we trying to take advantage of short-term declines? Are we just we're in it for the long run, no matter what happens? Like those are some combination of those things, right? But everyone has to figure it out for themselves. So I don't know the answer. I've heard lots of people's ideas. My personal preference is this idea of I'm going to look at it regularly and I'm going to do something. I'm going to get money that's set aside into the market and not just let it sit there and wait for the perfect time. But I mean, easier said than done, right? Sure is. Why would I be in something that could lose 20%, sorry, 18.9% in 1 week when I could just collect 4% and not lose any money? Good question. And so we'll keep going. Like, why would one do that, right? So to that exact point, like, why do we do this, right? Like, why would we be in something that is so volatile? So uncertainty, like we don't know what earnings are going to be. We don't know if the economy is going to grow or if it's going to shrink. When are we going to have a recession? How severe is it going to be? Who's it going to impact? Are we going to lose our job? Like, is some company going to show up and disrupt an entire industry? What about AI? How do all these things impact everything? Nobody knows, right? That's the uncertainty. So the uncertainty that we all are experiencing, we're all trying to gather this information. Every investor in the world taking information in, making decisions, and it reflecting in uncertainty and higher volatility than like that money market fund or that bank account that earns 4%, right? Much higher volatility. But that is the exact reason you get a higher rate of return in stocks. That's the payoff, right? No risk, no reward. You get, if you take no risk, you will get 4% on a 3-month CD for now until that rate changes. No more, no less, right? Here, if we're looking at these gold lines are daily volatility, so daily price change. I mean, the most dramatic one is this from 2020, right? We had 3 days here. You can't see them because they're all jumbled together. The stock market has these things called circuit breakers. where if stocks fall by, I think it's 8% in a day, it might be 5%. Now I can't remember what they are, but some percentage, let's call it 5%. The circuit breakers trigger and you pause trading. And just the stock market, Wall Street is like, everybody calm down, just take a breath, right? Because selling begets selling, and then you have a panic, and then it like takes on a life of its own. So they try to like cut that off. If the market falls another 3%, let's say, they stop it again. So first one is 5 minutes, second one is 15 minutes. So on this day where the stock market fell by 12% in one day, those circuit breakers got triggered twice, and we ended up down 12% in a day, even with the pause to pull yourself together a little bit, right? Because people were just panicking, right? That is so scary. Like you remember that, right? Like, and this was like on top of whatever we're trying to figure out what's happening with COVID too, right? And so this is very dramatic. And we can see the white line is the price change then on those days. So typically when you have a spike in volatility, you have a decline in prices because people panic fast, right? One of my favorite stock market sayings is bull markets take the elevator. No, bear markets take the elevator, bull markets take the stairs. So it means when things go bad, it's fast, right? Going to like that point about April. Everyone will sell at the same time and just like not even think about it. Sell, 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 sell. And then you're trying to buy and you're like, well, should I get in now? Should I wait? So bull markets take a while typically to come back. But we have these spikes in volatility. Sometimes the price change is like 0.5% here, 0.5% there, most of the time. We have this spike in volatility. This is April 9th. This is that day, 90-day pause. We had the spike in volatility, but like kind of unusually, it corresponded with a 9% change to the upside, right? We had just been down almost 20%. Scott Bessent, Treasury Secretary Scott Bessent, comes in front of the cameras during the trading day and says 90-day pause, and the market went up 9% in one day. I mean, that's like hard, right? Like sometimes the market, like many times the stock market does not go up 9% in a year, right? So that's a year's worth of return in one day, right? And so this is like, people don't like it, right? Typically, yeah. Yes, no, I'm sorry, a 90-day pause on tariffs. So it was the tariff news. Everybody was digesting these huge tariff numbers, trying to figure out like if they were real, what they were, what was happening, what the plan was. And then Treasury Secretary Scott Bessent convinced the president to put a 90-day pause on tariffs so that we could all collect ourselves. And it was really because like the stock market was reacting very badly, but the bond market started reacting very badly to all of this uncertainty. And the bond market is twice as big as the stock market and twice as important. And once you have cracks in the bond market, you have cracks in the financial system, and things go bad very fast. So that's like the global financial crisis from 2008, 2009 was cracks in the bond market and the financial system. No bueno. So luckily our secretary, our Treasury Secretary was like, this is like, we can't mess around with this. We're gonna just shoot ourselves in the foot for no reason. And that's where the 90-day pause came in. So but if we look at this, like we expect the stock market to double every 7 to 10 years. That's a 7 to 10% average rate of return over long periods of time. And like over decades and decades, the return tends to come back to 10% per year on average with wild swings, right? So never actually 10%, right? Sometimes it's up 50% and then down 24% and then up another 100%. And you don't know when those turns are gonna happen. So you have to just kind of think about the line that cuts through all of these things and say, okay, like I want to get on that line, but I know that from day to day, month to month, year to year, I'm not going to be on the line. I'm going to be way above it and way below it. Does that kind of make sense? But it's because of the volatility. Everybody who comes into our office says, maybe not everybody, but people come in and they say, I want a really high rate of return, but I want it to be safe. Right? Like, yes, that's what we all want, right? The highest safe rate of return we can get is 4.2% on a 3-month CD right now, right? That's it. You don't get 10% by playing it safe. If you want 10%, you have to take risk somewhere. That's just how the world works. So. Oh, yeah. 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 Right. And you have to know what it's going to feel like to do this, right? Yes. Yeah. It is so unpleasant, which I think most of you have probably experienced at this point, like how unpleasant it is. You feel so stupid. I have the same where, like, if I start panicking, yeah, I know that if I start feeling sick, that I need to wait because that's probably getting close to a turning point. It takes a long time for me to get nervous. And once I'm nervous, I'm like, okay, now we just got to get it another couple weeks. Hopefully we're getting towards the bottom here. We just got to give it time, right? But you can't give in to the panic wherever it gets triggered in you. But you do have to know, like, if you have money in your Roth IRA and you put it in the stock market on Monday, like, what are you going to do if it falls by 20% in a week or 50% in a year, right? If you know, I'm just not going to do anything. I'm going to forget the password. I'm not going to log in. I'm not going to sell. I'm going to get on the long term and wait it out. That's where you want to be. If that isn't where you can get, you're going to have a very, very hard time. You're going to do a lot of selling high and buying low, which just eats up your money, right? We're trying to buy low, sell high, right? Like, I think we all know that. But it's very challenging. And again, it's because of the volatility. You don't get to skip it. No one does, right? So you have to do it through knowing yourself and figuring out that strategy. Am I going to be buying when the market goes down, or am I going to be ignoring? Am I going to be crying but not hitting the sell button? Do whatever you want, but you're trying to figure out how to not hit the sell button. And so for a lot of people, the way to not hit the sell button is they don't buy in the first place, right? They don't get to be on this train. Any questions here, like on the volatility piece? Yeah. Mm-hmm. Mm-hmm. Yeah. 10 years of nothing, 10 years of sideways. It is. Yeah, I have a 10-year treasury chart. Yeah. Yeah. Yeah.
Just investing gold.
Yeah. Yeah. I have a bull case and a bear case coming up where we'll look at all those things and then we decide, right? Like what we think will happen. Because that's exactly right. Like you're always, and none of this will ever stop as an investor. You always have a bear case. How could things go wrong? You always have a bull case. How could things go right? And you don't know which one's going to happen ever. Right? You just are doing the best you can. Kind of going back to that, like I love this chart. It goes back to 1957. Here's your 10-year sideways where we had dot-com bubble burst, housing bubble burst, where you can see here, we didn't hit new all-time highs for a long time. That's called a secular bear market. It's a long-term bear market. You get all of the volatility with none of the upside. You waited here 15 years and you were back where you started. That is super painful and possible, right? Because it has happened. Most of the time, you have these long-term secular bull markets that can last longer than anybody expects. Momentum kind of begets momentum. Yeah. Yeah. I mean, imagine that even during these two very painful, dramatic bear markets, if you're saving in your 401k, okay, you're buying at the high here, but then you're buying at the low here. This investment is growing when it recovers. and then you give it all back, right? But it's still possible to make money. Most people kind of have this all in, all out mentality. What if I put all of my money in on this day, and then it falls, recovers, falls, recovers, and I have not made, and I put all of my money that I ever made in at this moment in time and didn't make any money for 15 years. But that's not typically how people actually invest. Most of us have 401ks that we're contributing to every month, right? So you're not always coming in at those highs. So there's still a way to make money. You're still receiving dividends, which are then buying more shares, but you don't make a lot of money. Not like you do. It's way easier if you buy here and ride it all the way up, right? That's more pleasant, right? We like that. But this just goes back. I think you guys can see there's all of these very, very bad things that happen. So again, like one of the things we do as investors, we're trying to figure out what's going to happen next. We read the headlines. They're always bad, right? Some of them really do have an impact on the market, and some of them don't. It's very hard to differentiate which ones are going to have an impact on the market and for how long and what's the magnitude. And it's hard to think about what a solution to a problem is when the problem is happening. So certainly, like you think back to COVID, are we just never going to be inside together again, right? People, it was hard to imagine in that moment of time, like, how is this going to get solved, right? It's very, very challenging. So you just kind of have to know that predictions are really hard, right? And one of the most common things I hear is, okay, I'm going to get out. I'm going to get back in when things are more stable. Which is like, yeah, you know how like what that turns into is once things are more stable, everybody knows it. And the market has already rebounded. It will never work to get in, to get out when things are bad, and to get in when things are stable. You will always be behind by like 3-6 months, right? The stock market is already looking forward to 2026, right? And so you will always be behind. So again, it's coming back to like, what is your strategy to stay invested, even when things seem obviously terrible? You have to stay invested. You can't jump in and out. It never works. So now if we kind of think forward, like if we're trying to make decisions like in the relatively short term, we can make like bearish cases for stocks, which is where I'll start, and then we'll make a bullish case for stocks. Okay, so the bearish case for stocks, this is my list. It's not an exhaustive list. You can probably come up with other things, but this is what I think about. First, this idea that American exceptionalism is waning or over. So it's the idea that things are going to be, it's going to be harder for investors in the US versus the rest of the world from now on because of the political system, right? So that's a case that people make. The second one here, the dreaded tariff, inflation, sentiment, growth scare, doom loop, right? So tariffs will make prices go up, which will make people feel bad, and it'll eventually lead to a recession, right? You can still make that case that that could happen, right? This third one is a new one. So this acronym TACO is like a funny acronym that someone from the Financial Times came up with, and it stands for Trump always chickens out. So people, one of the reasons for the recovery is that people think that if the markets get bad enough, that whatever tariffs have been put on will be taken off, right? Because we don't like the markets to fall. And if tariffs are causing the decline, can rescinding the tariffs or pausing the tariffs or renegotiating the tariffs bring the markets back, right? But that could be wrong. Like, what if tariffs are really high, they go on, and then they don't come off? And all of a sudden, like, the Trump administration doesn't care if the market falls, right? Good. That's a long time. Yeah. That's got 3.5 years, right? Oh. Oh. I think that's kind of why TACO works, though, is because we have midterm elections coming up next year, right? And the market's already in 2026. So everybody's already looking forward. Are you going to drive the economy needlessly, really, like into decline just in time for midterm elections? Or do you not have the appetite for that? It seems like, according to TACO, like you don't have the appetite for that, right? You don't want to lose elections. People don't like recessions, right? So yeah, so there's kind of all of these expectations around TACO. Business is pessimistic about sales. This is a new one. I have a chart about that, so we'll talk about that. Housing continues to look weak. high interest rates, housing is rough out there. Is anyone in real estate, like a profession? I've had at least 3 realtors cry on calls with me because of how bad it is, right? It's tough out there. It's bad, bad, bad. Bond market volatility may be signaling wider, more serious stress in the financial system. So we'll look at interest rates, yields on treasuries, Fed independence under threat. So this was big this week. Will Trump fire Jerome Powell, who's the head of the Federal Reserve? It would be like undeniably bad for the market. The market would not like it. We like the Fed to be independent and to make decisions about rates independently, not under pressure from politicians. And like I think that the Supreme Court actually has said that you can't fire the Fed chairman too. So there would definitely be a legal battle over it. Higher volatility tends to result in lower short-term returns, right? So if any of these things cause that kick up in volatility that we talked about, we saw that usually when volatility kicks up, it's because prices are going down. Those things tend to be correlated. And then down here, like at the beginning of the year, I did have decreased government spending could be a drag on GDP, if not offset by monetary or fiscal stimulus. That's kind of resolved since the OBBBA was passed earlier this year. We do not have decreased government spending. We have increased government spending, right? And so that's just kind of resolved. The fear and greed index. So this is showing us, a lot of people think that like this is a sentiment indicator, like how are people feeling? So in April, like during that week, this was all the way over at 21 in extreme fear. And then 3 months later, it was all the way over into extreme greed category. Sometimes people try to use this as like a contra indicator, like be fearful when others are greedy, greedy when others are fearful in the short term. So one could then see like, oh, well, if everybody else is greedy, we should start being afraid, right? You could say that. So I'm still on the bearish case, by the way, right? So we're gonna try to freak ourselves out a little bit. If we look at the fear and greed index since 2021, so the fear and greed index is the blue line. I mean, this is like, again, classic investor behavior. We ping pong from fear and greed back and forth. The red line is the price of the S&P 500, so stock market performance during those periods of time. I mean, you can kind of see like, okay, when the stock market goes down, people get fearful because the market is down, right? So they are like pretty correlated. This just tends to be something I like to keep an eye on, but not really make like a hard and fast decision based on something like a sentiment indicator, right? Because it's okay, like some of us can be fearful and also like not be selling stocks, right? Like, so we can just like yeah, like no shit, Sherlock, like I'm scared, right? That doesn't mean we have to do anything about it. Oh, they have the methodology on there and I'm kind of blanking on what it is. I think it's a combination of investor surveys and maybe like put call ratios that they're monitoring. It's yeah, the methodology is on CNN where they show you how they do it. This one is kind of new and I thought was interesting, like as a business owner and thinking about that stocks are businesses, right? The National Federation of Independent Business survey shows this core sales trending up, right? So what this is saying is businesses reporting that poor sales are their single most important problem. So sales are the lifeblood of the economy, right? Like we take our paychecks or we take our money and we go and buy something. By buying something, our money turns into a paycheck for someone else, right? And that kind of virtuous cycle is what keeps the economy running. So if we have business owners here who are increasingly saying that they're worried about poor sales, it's something to note, right? I mean, but we can also see like the levels are not extreme here. It's a trend to keep an eye on, but it's not like the levels are not as high as they get during recessions. So it's just kind of something like, huh, that's weird. Like if the economy's so good, why are poor sales becoming an increasing worry for business owners? So this, I think, is something to keep an eye on, right? But then on the other side, over here, business owners saying inflation is their single most important problem. You can see that clearly trending down. So that was all the rage in 2022, where it was very, very serious. And now people are less and less worried about it. Yeah. 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 What did they say? Yeah. Did they say why, or like, is there any more like anecdotal evidence? It's just like, oh, like people are. Mm. Yeah.
Is like a vendor to larger business.
Yeah.
So if those are having harder time,
Yeah.
buying,
Yeah. That's very interesting.
it's really weird to see. Like I'm thinking of sales.
Yeah. Yeah. Right. Right. And it's trying to help others learn how to sell. Right. Yeah. 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 Very interesting.
It changed. No, I've been doing this for a long time. It changed in such a big way.
Yeah. Yeah.
So what I've found is working, and I'm seeing other people getting this is, I think this is about our movement, is instead of just that someone would refer someone to me and have one conversation with them, and then you know, if it was truly they were looking for what I do, it was easy to say yes to them, to say yes to them. Now I have to talk to them multiple times.
Yeah.
I have to put them in groups.
Yeah.
They have to see me in action.
Yeah.
They have to ask me. It's like 10 times harder.
Yeah. So something is changing with the way people are making that decision. Yeah.
Some good in it. I think the lining to the hope of it all is I think people are refusing to buy things anymore.
Yeah.
People are just not willing to buy things that they want to get things.
Yeah. Yeah.
And I'm seeing, so
yeah.
That's another.
Yeah.
But the other, so then people are more reluctant. I think, what is this?
Yeah. 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 Thank you for sharing. That's very interesting. Did anyone have a hand up over here? Yeah. They're reporting that it's their single most important problem. So if you have like the CEO of a company, like looking at the landscape and they're like, okay, like what is not going well? What's our biggest problem as a company? It's them reporting poor sales as being a problem, right? Because sometimes it can be like, oh, well, sales are up, but so are expenses because of inflation. In that case, like the sales aren't the problem, the inflation is the problem. Or sales aren't the problem, hiring is the problem, right? So this is them reporting that, oh, like that top line is a problem.
I remember.
Yeah. So this is you? Well, thank you. Yeah. Yeah. Yeah.
And then they just started sitting them all the time, and I was like, normal.
Yeah.
Like a few years ago, they just started coming all the time. And then they came so often that at one point, I read the time frame that it is now optional. Like it suddenly had shifted to optional.
Yeah.
But they wrote it really small, so people kept telling it out.
Yeah.
And it was like, what's your business's biggest problem?
Yeah.
Like the thing. These are charts.
Yeah.
How many?
Yeah. Yeah.
But they were really interested. The overall survey was really interesting in how people were, if people were worried about AI, like if you looked at the questions and thought about what they were trying to gather, if they were trying to figure out if businesses were thinking about AI or not, using it or not, if they had plans in the future use it or not, they had seen loss of sales, they had fired people.
Yeah.
That's really what they were trying to understand.
Very interesting.
So, yeah.
Yeah.
Like,
Yeah. 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 Anticipation. Yeah. 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 Yeah.
And they can right now.
Yeah.
But it's true, and I think my humble opinion is what I'm seeing, and I'm talking to a lot of that thing. I think we're gonna see a lot of businesses / consumers stop trusting people and try to trust it in a minute. I think it'll like dip in that regard, but I think it'll come. For example, the certificate, most apps thing.
Yeah.
Not last year.
No.
2024 was not mental health.
No.
It was changed.
No.
So it's massively changed. So to like this thing do and they're really and then they'll figure out like struggling with some like emotional and relationship stuff. And it's like using ChatGPT, and in the middle of between two sessions was like, how's that going for you? And he told me. Then I said, well, would you like to know what an expert thinks about that? And I said all this other stuff, and he came back later and he was like, that was so helpful. Like, so it's not quite solving their problems, but it's like enough to seem like it's good.
Yeah.
And like technological movement, because they're using their jobs for purpose. But it's real.
Yeah.
But I think that needs like a depth. And then the other thing that I think government may put tariffs or taxes on businesses that don't have enough.
Yeah. I mean, all of these things, right? Yeah. Like,
just to keep it from
yeah. Yeah. And maybe we can like circle back on it like during the Q&A too to kind of think through this, but it's like an example of just uncertainty injected into the system, right? And so like for people looking for certainty, like you will never get it, right? Because like this like AI, it just like came back out of hibernation 2022. That's like relatively, it's not that long ago when ChatGPT went live, right? And so there's still like all of this uncertainty in the system, again, without knowing exactly what the ramifications are. If we keep going with like other like bearish things that make people feel pessimistic about the stock market, this is the S&P 500 index forward PE ratio. So PE, the P is the price of the S&P 500 in this case. The E in the denominator is earnings. So like kind of the analogy I like to make is towards like price per square foot. Like if you've ever been in the real estate market, right? Like, you know, price per square foot is higher in certain neighborhoods for some reason, right? Like for whatever reason. So this is, if you take the price of the S&P 500 and then the earnings those companies actually create, you can track that number. And you can see that the PE ratio, it tends to go up when people are optimistic and down when people are pessimistic. So one of the things that people would say now is like, well, you know, this PE ratio of 22 on a relative basis, if we look at the chart, looks high. And so like people will express that as like, it looks overvalued, right? Or it looks too expensive. I don't want to buy stocks at a PE of 22. I want to buy them at a PE of 18, right? So this is one way that investors will kind of make that decision. Are stocks overvalued, fairly valued, or undervalued based on either their history or based on other options? So this is showing that same PE ratio, but with 4 different categories. The pink line are mega cap tech. So what do I have over there? Mega cap 8, which are NVIDIA, Apple, Microsoft, Meta, Google, Tesla, and 2 other ones I can't think of off the top of my head, right? But you get the gist. And so you can see the PE ratio of mega cap tech is higher than the S&P 500 in general and is higher than smaller companies, right? So people are willing to pay more for mega cap tech than they're willing to pay for these other types of stocks. But then we can also see like that valuation has come down quite a bit from where it was, right? Like this is like astronomical coming out of COVID levels. And so these are some of the things that people take into consideration, like, am I willing to buy stocks and what types of stocks am I willing to buy, right? Mega cap tech has been, even though you have these very, very lofty PE ratios, been a pretty good investment over the last 5 years, right? So just because you pay a high PE ratio does not mean you're not going to make money, right? But it does make it a little bit more difficult, right? It's like buying the nicest house in the neighborhood, right? Like, what are the chances that like you're overpaying? They're higher than if you buy the cheapest house in the neighborhood, right, on price per square foot basis. So this is something that people keep an eye on. And it's when you hear people say overvalued, undervalued, this is typically what they're talking about, right? Like based on how much these companies actually earn, how much are we paying for them? Yep. Earnings and profit are the same thing. So this is the profits of the company in the denominator, or the earnings in the denominator, but we call it PE ratio. Correct. Yeah. Yeah. Yes. Mm-hmm. Mm-hmm. High PE ratio. Yeah. Right. Because you have to start thinking about how fast does the E grow. So typically, like high PE ratio stocks, the reason that they're so high is because you expect that E to grow exponentially. Like, what if you can double earnings in a year, right? And so that's usually high PE ratio companies. The reason they're at a high PE ratio is because you expect their profits to go up by a lot very quickly. But then what happens if they don't? Then you just like overpaid for something that never really happened. I mean, that's just a risk of investing, right? Yeah, yes. So like a classic example of it is when a company reports higher than expected earnings and then the stock falls, which is like, what? Like they did better though. Like, why did it fall? It's because even though they reported better than expected earnings, the earnings weren't as good as investors actually secretly expected, right? And so you can still like you can still grow your earnings and disappoint your investors. So it's challenging, and it makes growth stocks, those high PE ratio stocks, wildly volatile. People get really, really excited, and then people get despondent about it. Like, so it makes growth stock investing, which is what we call like high PE companies. Growth stocks tend to be much more volatile than what we call value stocks, which like Warren Buffett is really well known as like a value investor, where you're kind of sticking, you only buy when things are cheap, right? It's like the stingy person's like investing, right? Like I'm only going to buy low. I'm only going to buy on sale, right? So they're different styles, right? It does, and a lot of analysis. And so, but this is what people are talking about with like overvalued versus undervalued. All right, I'm going to keep going. I'm going to try to go a little bit faster too, just, and we can always come back to things. The next two slides are bond yields. And so the reason I'm bringing this up is going back to like the housing market. So this is the 10-year bond yield. We can see here that it really it peaked back in 2023 and has since then been like in this pretty tight range. Typically when yields go up, it makes borrowing more expensive, right? Like for the US government, who is borrowing in the treasury market, but also for consumers. They're like, oh, well, more of my money is going to debt payments. That's less money I'm spending at wherever I'm spending money, right? So it can have an effect on the markets. So this, like, people expected for a long time, we had real estate meetings where like we had mortgage people who were expecting mortgage rates to go back down towards 5. I think that was in 2023 or 2024 we had that meeting, and that has not happened. So this is the 10-year, and then this is the 30-year. So we can see here that if we think about 30-year mortgages, 30-year treasuries, they're going to be correlated. We can see here 30-year yields came up in 2023. And since then, like those borrowing rates have not come down. They've gone sideways. The 10-year? Yeah. Yeah. I mean, that would make sense. And so even if we're just looking at trends, like this idea of lower rates, and these rates also, they're set by the market. That's really super important. They're set by, if you were going to lend me money for 30 years, what would you charge me, right? You would charge me at least 5%, if not more, because I'm just a person who you barely know. So you'd probably charge me something higher, right? So these rates are set by the market. They're not set by the Fed, set by the market. That's very important. But here, like the market is saying, we don't think that rates are going to go down. And if that's the case, it's going to continue to be very challenging for borrowers, which is mostly real estate, right? You borrow money to buy real estate. So that's, yeah, and cars, right? Major big purchases you borrow money for. Yeah. Yeah. Yeah, that would, I mean, that's often kind of cited. Like if China dumped all of their treasuries, they would blow themselves up. So it's like mutually assured destruction. Like I kind of get, but it's not, I don't think the Treasury is scared of that, but the Treasury is scared about like if you have to continue refinancing 30-year debt that is coming due, so debt that was issued 30 years ago, let's say, it's like when you refi at a higher rate. That's what they're worried about, is low interest rate coming due, and then you have to refi it at a higher rate because, yeah, all of the things, like, so it can be commercial real estate, it can be your house, it can be treasuries, it can be all of it is a challenging environment. Like, and now we just passed this budget that is not paying down the debt, it's increasing it. And so the treasury market has to absorb that somehow. Like we have to refinance US national debt that's coming due, and it's being refinanced at higher rates. And so when does that really become like something we can't tolerate or can't absorb, or lead to like a upward spiral in rates, which just makes it worse? So that's why it's on the bearish case, right? It's like Besant wants lower rates. So like how do you do that, right? Like it seems it's not easy, right? You have to get people, yeah, you have to get people to lend to you at lower rates. That's what makes the lower rates. Yeah. 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 People don't like it. So bearish, right? Here's just putting like 10-year bond yields into context. They were super duper low as recently as 2021, and now they're higher. And like in the grand scheme of things, they're not abnormally high, but they're much higher than they were. Okay, so now I might go through this a little bit quicker just so we can come back to it. The bullish case for stocks. So this is like, okay, now that everybody is sufficiently freaked out and worried about bond yields, like, okay, what could go right, right? So the bullish case. The first bullet point is the stock market is still in a bull market. Bull markets can last long times, right? So we're going to look at that, or last a long time. Investors are adapting. So back to this idea, like we're all like adjusting our expectations with new information that's coming in, and volatility is way down, right? So people feel like they have more answers than they did 3 months ago. We're going to look at the SOM rule, which is an indicator of recession. Recessions are very bad for the stock market. People lose their jobs, that they don't have money to spend in the economy contracts. It's all very bad. So we do want to keep an eye on like, do we think a recession is looming or not? Technology-driven innovation. So we already talked about that. We'll probably try to jam through that one pretty quick and then come back to it. Most technology-driven innovation is disinflationary, right? So just the very simple example of replacing payroll with a one-time investment in technology, right? You get rid of the cost to pay a person and you replace it with a an algorithm or an LLM, right? Liara would be precise about. That's disinflationary versus inflationary. It brings prices down, right? Replacing a person with a robot. Earnings are coming in okay, which is good for stocks, has been so far in the first week of earnings season. Jobs are coming in okay. Inflation is trending downward. Consumer is still strong, meaning that people in the aggregate have jobs, low debt, and money in their pockets. And then we're going to look at household wealth, like who are the people that have all the wealth, right? And how do they typically act? So here with bull markets can last a very long time. Like I have all these stock markets saying, you guys, I'm so sorry, but there's one that says like bull markets don't die of old age, right? They don't just stop being bull markets. Something happens. They don't just like end one day. So here you can see that bull markets, especially in recent history, so like this is like 1983, bear markets used to happen way more frequently, kind of back in the day. And since then, this probably has a lot to do with the Federal Reserve. Now you can kind of keep economic growth going for longer, and bull markets can last a really long time. So this is like how long between 20% declines in the stock market. That's what a bear market is. So a 20% decline. So here, like this is a table from December. And so I went through and added up as of that period, that point in time, the bull market had lasted 786 days. If we bring that through to July, this bull market has lasted about 1,000 days because we didn't quite hit that bear market in April, so it didn't trigger a red line. But you can see over here, like here's a bull market from 2009 to 2020 that lasted 4,000 days, right? So they can last a long time. Just because we've had 1,000 days since our last bear market does not mean a bear market is imminent. So I love that chart. The economy is still growing. There's kind of two ways that you can track this in real time. You can get an app on your phone if you're a dork, and you can have them send this to you, push GDP Now, the Atlanta Fed estimates in real time with their methodology what they think, how fast they think the economy is growing. If it's above zero, then the economy is expanding. If it's below zero, it's contracting, right? So we are well above zero. This is the zero line. And then we can cross-reference the Atlanta Fed with the New York Fed. They do the same thing. This looks bad because it's trending downward, but our zero line is here. So even though the New York Fed has brought their estimate down for how fast the economy is growing, it's still well above zero. So we looked at this in we looked at this, there was like a vibe session. Was that last year? Now my years are all mixed up, but there was 1 year where everybody was calling for a recession, and these numbers were not coming in even close to a recession, right? So we can keep an eye on this and be like, okay, is the economy really contracting? Like there are lots of places where you can get that information. You don't just have to go off vibes, right? No, it's the Fed, the New York Fed. So the office that's based in New York does this for the US gross domestic product. And the Atlanta one, same thing. Yeah, two different offices. So there's Federal Reserve offices all over the country, but those two offices report this data. You can keep an eye on that. Here's like investor expectations adapting. I won't go through this because we've talked about it a lot, but this blue line is Google searches for the word tariff, right? Spike, decline, now we're kind of over it. We're all like, know what tariffs are, right? Here, companies lowering their guidance. So again, like when a company reports earnings, they also talk about what they think is going to happen in the future. In the first, like in April, everybody was saying, oh, this is going to be much worse than expected because of the tariffs. And now companies are reversing that and saying like, oh, things aren't going to be as bad. Like we're raising guidance, right? Because we have a little bit more clarity around what this might look like. And then this is US economic policy uncertainty index. So all of these different measures, this is just trying to like put a number on how uncertain do we think. It is in the economy, and we can it's still elevated, but down a lot since April. So people are feeling better about this. The SOM rule is, this is from the St. Louis Federal Reserve. So it's looking at the change in unemployment rates. So all you need to know is once the SOM rule reaches 0.5, It has until this point in time, but all of these other times, it has told us that we are in recession. It measures like the change in unemployment. So if short-term unemployment is going up very quickly, like, oh shoot, like people are laying people off, like companies are laying people off, and that typically is a coincident indicator of a recession. That's what a recession is. Like business is bad, we're laying people off, the economy is contracting. And so we are not close to that now. It stands for Claudia Sahm. She is the economist who invented it. And then, you guys, like I sent Claudia Sahm a LinkedIn message and she agreed to be on my podcast. It's like if you have a favorite economist like me, so we did this whole episode with her about like she used to work for the Fed, like what is the Fed, what is the Sahm rule, and how do you use it? And she's just like the most lovely person, like super interesting. So if you're into wanting to know more about like what the Federal Reserve is for and how it works, we got to talk to her about that, and she's just lovely, right? Oh, and then going back, like again, the reason we care is that, well, lots of reasons. We want to be prepared if we're about to lose our job. And also, stock market declines are more severe when they happen during recessions. You don't need a recession to have a bear market. But typically, when you have a bear market in a recession, it's much worse, right? So 50% declines in the stock market. You do not want to find yourself no job and the market down 50%, and you need to sell your stocks to pay the bills because you lost your job. So this is like where financial planning comes in, right? This is what the emergency fund is for. Like it's what asset allocation, like how much do I have in stocks versus not in stocks? Because it's worse when you have a bear market in a recession. Here, this is just a chart showing these inflation expectations that they came down a lot, and then they're like kind of trending down. The blue line is actual inflation, and the red line is inflation expectations. Both of those things are important. But it's still trending downward, which is good for the market. This is showing the gold line are people looking for jobs, and the white line is how many jobs are available. I think is really interesting. Like for most of this timeline, you have way fewer jobs than people looking. But since this massive like COVID whipsaw effect, like now they're very close. They look like, I mean, this kind of anecdotally, like with people looking for jobs, like, yeah, it's not the same as it was when there were way more jobs or than people just a few years ago. But there still are, in the aggregate, more job openings than people looking for jobs, though that gap does look to be closing. I love this chart. I think this is really important and something that I think is like underreported. This is showing like the highest 20% of earners and the percent of total consumer spending in the US that those high earners make up. If you add up these 40% of people, the highest earning people, they spend 60% of the money in the economy, right? So this is not a judgment call, right? As to whether this is good or bad. It is just numbers that wealthy people spend the majority of the money in the economy. So if those people have money, can you keep an economy going longer than is expected, right? It's a case to be made because sometimes there's, like we focus on people on the margins, right? Lose their job, and that is very important, right? Like from a policy perspective, but from an economic perspective or a market perspective, it doesn't affect the market as much, right? The people who don't spend the most don't impact the markets as much. Is that's it might be. Yeah, it might be. So that would be important to know, right? It's like what would cause 60% of the people to pull back. And like the next piece, which I think is super, this is showing like in the aggregate household net worth. So again, like people have more wealth than they have ever had before, right? You can see like down here during the housing bubble that it also got way above trend line and then came back down. This is above trend line and might come back down. But as of like this moment, people have a lot of wealth. A lot of people have paid for houses. And if we keep going with this, households in the aggregate have a relatively low debt as a percentage of income. And then there's this whole like US economy secret weapon from this Wall Street Journal article, which is who are the people with all the money? Baby boomers. Yep. Paid for house, like stocks at all-time highs, just out spending money, right? Like it's, I mean, it's interesting, like for this, like the wealth is like people spending wealth is what makes the economy keep going. So what is like, what might stop that, right? Like if we think like, okay, if we, this again is the bullish case for stocks, what could cause the economy to slow down? If we think about the financial crisis was a decline in housing prices versus the amount of debt that people had borrowed to pay for those houses. It's going to be hard for that to happen again because many of these people have way more equity and even paid for houses, right? So you don't have that same pressure to sell houses. This is just like, I find this very interesting, right? Absolutely, right? Slow motion, right? Like, but if you go from like accumulating wealth to spending it, that's, I don't know, without knowing like exactly how it transmits through the economy, in my mind, it means like there's like a, not a safety net, but there's like a big chunk of money that is not, even if prices go down, it doesn't have to become catastrophic, if that makes sense, right? Like more stable asset base, less debt across the board, which is different from what happened during 2008, 2009. So just thoughts to take with you, like, and then we can go to Q&A. So like, this is where I try to take all of this and like put it into action. How are we making investing decisions, right? I ask everybody, like, how did you feel in April? Like, how did that go for you, right? Like it went different for a bunch of people. And then how does July feel now? This is just a really easy way to check in behaviorally on what we do when things get really bad, really fast. And then what we do when things recover, right? We have like 6 months, like recent memory where we can check in. Like, does your plan feel robust? Did you feel like you were taking too much risk or too little risk? Now, when stocks are at or near all-time highs, you can adjust that based on how you felt in April. Cash has always been a ballast in the storm. If you need a ballast, cash is the only thing. You can still get 4%, right? Stocks have always been long-term wealth generators. Past performance is not indicative of future results, so that doesn't mean that they for sure will be going forward. But if we use that experience, then we use stocks to generate wealth over the long run, but we use cash to be our stable base when things get tough. So you need to figure out what your balance is. And then this other question, like, do you need to understand how or why stocks do what they do? I think this is kind of an open question. I know a lot of people who are like, I don't really know. I just put it in there and then I'll come back in 20 years, which is like a pretty good, I know, Casey never, like, I'm always like trying to talk to Casey about the stock market. She's like, no, thank you. She's like, I'll snooze in the back and record it while you talk about it, right? But like, it kind of does go to the system's too complex to be predictable. So it's almost like you can't know enough. Like, I love knowing about it. I think it's fascinating. And I think knowledge is power, but you're never going to know enough to know everything. And you're never going to know enough to be for sure certain about the way things are going to play out, right? So you do have to get comfortable being uncomfortable, and you have to get very comfortable with uncertainty. No one has any clarity into how bear markets are resolved other than time. So when the market goes down, we don't know if it's going to get worse. We don't know how fast it's going to rebound. Is it going to be V-shaped? Is it going to be like a check mark? Is it going to be an L, the dreaded L, right? And even if you get a prediction right, you can still get the outcome wrong. So you could have been right about tariffs on April 1st. And you could still be sitting in cash today and have missed the rally off the bottom, right? So it's very tricky to kind of be jumping in and jumping out. And you also, I think you don't want to get into this mindset that you should be or can effectively make predictions. You get it right once, but that is not an indication that you're going to get it right every time. And so, what's that? Oh, yeah. Oh my gosh. I love the Cathie Wood story, by the way. Just like, we could spend time on that a little bit later if you guys want to. But here, this is like, if we can't know what's happening in the stock market, we do a lot of time like spending time on things we can control, right? So investments are, this is Casey Lowe saying this, investments are part of your financial plan, but your financial plan is not just investments, right? So you have lots of other things you can control. How much cash do I have in my emergency savings? Like how secure or insecure is my job, right? How much credit card debt do I have? How much student loan debt do I have? Like there's all of these things that you have more control over, where you have like little to no control over the stock market. Oh, and so we made it. We made it through. All right, so.
And I don't know if,
no.
I don't even really know if
yeah.
this Bitcoin thing is.
Yeah. Yeah. We did, like, we have a recording on the YouTube channel that has like a more in-depth, right? So stocks are one asset class. Stocks are ownership of a company. Bonds are another asset class. Gold is another asset class. So these are like types of investments that act similar to each other. They have similar characteristics. Bitcoin and cryptocurrencies, so crypto, like cryptography, like computers, right? And currency, like what do we use instead of dollars or something like that. Bitcoin and cryptocurrency are a brand new asset class, invented in 2013? Was that when Bitcoin was invented? So we don't totally know what it is yet. Some people think of it like digital gold, like you would use it in the same way you use gold. It's like there's only 21 million Bitcoin will be created. And so people think like, okay, if the US government, for example, can create unlimited numbers of dollars, but you can only create 21 million Bitcoin, is it a better store of value than US dollars? That's one argument for investing in Bitcoin. I will say that it seems like Bitcoin has the same or a very similar like risk-taking properties as tech stocks, where it's speculation. It's like, how fast can we drive up the price of this asset that very few people understand and very few people are involved in. So like we could do like a whole thing on Bitcoin. Does anyone here like have like, no. Yeah, I mean, but I do think it's accurate to say that like the question of like what is Bitcoin is actually like pretty hard, like from an investing perspective, to answer. It's all decentralized. Nobody's in charge of it, which is appealing to some types of people, right? Like libertarians love that idea, right? That there's no government in charge. There's only a network of people who believe that this is an asset class, and so it is an asset class. So if you're libertarian minded, that is very appealing, right? So maybe that like that feeling of like being more appealing to a certain like political party is probably kind of accurate. I see like the current Bitcoin rally as being Bitcoin enthusiasts recognizing in this administration the appetite to deregulate the whole industry. Because that's, I mean, Republicans like to deregulate things, right? They don't like regulation, like almost by definition of the Republican Party. And so if you take away the regulations around cryptocurrency in general, it tends to drive the prices up. I think that's what's happening right now, right? but there's still like very few people who invest in cryptocurrency in the aggregate. So as people get more comfortable with it and as an asset class, are more and more people going to start adding it to their portfolio like they have stocks, right? Do you have stocks, bonds, cash, and crypto? Like more and more people, especially like younger generations, they're almost like crypto natives. Like they start there. They don't end there. Like, I don't know. I feel like with myself, I'm like, well, you know, maybe we could add a sliver. And I have young people who come in, they're like, well, I already have my diversified portfolio of digital coins. Like now, like, should I add some stocks? I'm like, oh, you started on the wrong side of the spectrum, right? But I think this is how it's going to be in the future. I think like the verdict is in that it's here to stay. So I think you can get pretty far with like the normal asset classes. You don't necessarily have to add it to a portfolio, but there are plenty of people who are becoming more and more comfortable with it as like a sliver of your pie, right? It is wildly speculative, right? Like down 80%, up 1,000%. So it's even wilder than stocks. You have to be ready for that. Yeah. Oh, yeah. Oh my gosh, I'm blanking on it too. Yeah. 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 We should bring that back up and resend it out to people. Yeah. 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 Oh yeah. Mm-hmm. Oh, Investera. Yep. Investera. Yeah. 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 And they did explain it really well. They were trying to start a, a crypto investing platform specifically for women, and it didn't take off because I don't think it ever like spun up into something that's still around today. But they are very knowledgeable like about it. Investera, yeah. And so I don't know if yes, yeah, 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 yeah. Mm-hmm. That's interesting. Interesting. Yeah. 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 I mean, that's an awesome question. And I don't know. I mean, if you think of all the places you store money, like what would you sell in and take it out of something and put it into crypto? Or do you want to keep going with that? Yeah, their Bitcoin fund. Mm-hmm. Mm-hmm. Yeah, like the ETF, I bet. Mm-hmm. Yeah, 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 yeah. It's like the fund. Yeah, 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 yeah. Mm-hmm. Yeah. No, I think people are excited. Yeah, 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 yeah. I mean, even if we like zoom all the way out, which I think like for Leora's question is like, if you look at like, you think about your pie, how do I decide how much of my wealth, like how much of, where's my, the, the household net worth, right? Here, the net worth, the crypto component of this net worth is probably negligible, right? It's probably less than 1%, less than 0.5%. This is people's homes. This is people's, this is land, this is stocks, this is bonds, this is cash, this is all the normal stuff that we all know and love, right? And very little crypto. So as investors, the makeup demographically change of crypto, I think it is interesting to think about like if more and more people allocate to crypto, where do they pull the allocation from? Do they hold fewer US dollars, less in their like US dollar denominated bank account and more in crypto? Do they pull it out of the stock market and put it into crypto because they have similar risk characteristics, high return, high risk, right? Do they pull it out of their bond portfolio because bonds are boring? Do they not buy houses and instead they buy crypto, right? Yeah, yeah, yeah. I think it's interesting to think about, right? Like, yeah, yeah, like speculators. Yeah, yeah. I know. So that means that we are at the end of our road, like having to clean up and put the room back together. But you guys, like this was an amazing discussion. I don't know if anybody like feels like one way or the other. Like, should we vote? Like, is anyone like who after this or like coming in, like who is still like very worried and like bearish, pessimistic on the stock market? Anybody? Maybe? Yeah. Yeah. Pessimistic in general. All right, that's right. Yeah. Is anyone like, oh no, like I'm like pretty optimistic about things are going, how things are going? Yeah. 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 And then in the middle, right? Yeah. Yeah. She's the person to talk to. That's Casey's jam. Yeah. Correct. It means you're an owner of the company. You don't just support them, you own them. Yeah. Yeah. I think you laid it out exactly. Like if it's important to you to only own things that you like, the ownership is a reflection of you and your values, then that's a way to invest, right? The stock market only cares about money, right? So like it won't make those, it does not have a moral compass.